If you walked into your bank tomorrow morning to withdraw $20,000 in cash for a roof repair, a medical procedure, a down payment on a car for your grandson, or simply because you wanted the cash secured at home, here is what would happen in this exact order. Without your awareness or permission, before you finish signing the withdrawal slip, a federal reporting form would be opened in the bank's compliance software. Before the teller counted the cash, your name, your address, your social security number, and the amount of the withdrawal would be entered into a database that is shared with the Internal Revenue Service, the Financial Crimes Enforcement Network, the Federal Bureau of Investigation, and 20 other federal agencies. Before you reach the parking lot with the cash in your hand, a currency transaction report, formerly known as Financial Institution Form 112, would be filed on you. And depending on how the bank's compliance officer interprets your transaction, a second separate report called a suspicious activity report may also have been filed. You would not be told. You would not see it. You would not have any way to find out. And under federal law, the bank is legally prohibited from telling you that the report exists. This is not theoretical. This is not a worst-case scenario. This is the standard mandatory everyday procedure inside every federally insured bank in the United States, applied to every customer transaction over a specific dollar threshold, governed by a federal law signed in 1970 and significantly expanded after 2010. And the legal authority that lets your bank do all of this without your permission is sitting right now in a document you signed when you opened your account that almost no retiree in America has ever actually read. In this video, I'm going to show you exactly which clauses in your bank's standard account agreement give them the legal power to do this, the 3 different federal reports they can file on you, and the thresholds that trigger each one. The true story of a 67-year-old Iowa restaurant owner named Carol who lost $32,820 to civil asset forfeiture without ever being charged with a crime. The historical explanation of how American banks became deputized federal informants between the year 1933 and today. Why retirees specifically are the highest flagged demographic in the federal banking surveillance system, and the 5 protection moves every retiree with significant cash savings needs to put in place this week. My name is Ivy. I am an enrolled agent federally licensed to represent taxpayers in front of the Internal Revenue Service, and I work every week with retired clients who have just received a letter from the IRS or the Financial Crimes Enforcement Network and have no idea why. The most common cause is exactly what I am about to walk you through. Let me start with the document you signed. When you opened your checking account, your savings account, or any other deposit account at any major American bank, you signed a document that is somewhere between 30 and 70 pages long, depending on the institution. You probably signed the signature card on top of the stack. The bank teller pulled the paperwork away, and you walked out with a debit card and a checkbook. The document, which is variously called the account agreement, the deposit account agreement, the account terms and conditions, or the customer agreement, is the legal contract between you and the bank that governs every single transaction you will ever make on that account for as long as the account is open. And inside that document, the bank reserves a series of legal rights that almost no customer ever realizes they granted. Right? Number 1, the right to refuse service. Every standard account agreement in the United States contains a clause stating that the bank may at its sole and absolute discretion refuse to process any transaction, refuse to release any deposit, refuse to honor any check, and refuse to permit any withdrawal with or without explanation for any reason or for no reason at all. This is the legal mechanism that lets a bank tell you on any given Tuesday morning that they will not give you your own money today. They do not have to provide a reason. They do not have to provide a timeline. They are legally protected. Right. Number 2, the right to close your account. The same account agreement contains a clause stating that the bank may close your account at any time without notice, without cause, and without obligation to provide any explanation. The bank will mail you a check for your remaining balance, and your relationship with that institution is ended. This is the legal mechanism that powers what is sometimes called debanking, the practice of major financial institutions closing accounts of customers whose business or political affiliations have been flagged in the bank's risk profile. You have no right of appeal. You have no right to know why. Right. Number 3, the right to file federal reports on your activity. The account agreement explicitly states that the bank is required to comply with all federal banking regulations, including the Bank Secrecy Act, the Patriot Act, and the regulations of the Financial Crimes Enforcement Network, and that the bank may, at its discretion, file any reports required or permitted by law without notifying the customer. By signing the agreement, you have already given the bank the legal authority to file federal reports on every transaction you make. Right. Number 4. The right to hold your deposits. Under Federal Reserve Regulation CC, banks are legally permitted to hold deposits for up to 2 business days for local checks, 5 to 9 business days for non-local or large checks, and longer if the bank invokes a reasonable cause exception, which the account agreement specifically authorizes them to do. Your money can be in their building, displayed in your account balance, and still be legally inaccessible to you for up to 2 weeks, right? Number 5, the right to a 72-hour senior protection hold under financial institution guidance issued in 2024, combined with senior safe banking laws now passed in over 37 states. Banks have legal immunity to delay any transaction on a senior customer's account for up to 72 hours. If the bank suspects the senior may be the victim of financial exploitation, the bank does not have to be correct. The bank does not have to inform you of the delay. The bank just has to suspect. These 5 rights are inside the document every retiree signed. They are not hidden in fine print. They are explicitly stated in plain English in the standard contract every bank in the United States uses. And the reason the bank has these rights is that since 1970, the federal government has effectively converted every American bank into a deputized federal informant with reporting obligations to the IRS, the FBI, financial institution, and the Department of Homeland Security on every transaction every customer makes. Now let me walk you through the 3 specific federal reports your bank can file on you, the dollar thresholds that trigger each one, and what each report actually does inside the federal banking surveillance system. The first report is the Currency Transaction Report, formerly Financial Institution Form 112. The Currency Transaction Report is mandatory, automatic, and non-discretionary. Any cash transaction, deposit, or withdrawal that exceeds $10,000 in a single banking day must be reported. The threshold has not been adjusted for inflation since the law was passed in 1970. $10,000 in 1970 is equivalent to roughly $81,000 in today's purchasing power. The form is filed within 15 days of the transaction, deposited into the financial institution database, cross-referenced against every other report in the system, and retained for at least 5 years. The second report is the Suspicious Activity Report, formerly Financial Institution Form 111. The Suspicious Activity Report is filed at the discretion of the bank's compliance officer with no minimum dollar threshold on any transaction or pattern of transactions that the bank deems suspicious. The bank is legally prohibited from informing the customer that a suspicious activity report has been filed. Customers who ask the bank whether a report exists must by law be told that the bank cannot disclose that information. The Suspicious Activity Report is the federal banking surveillance system's most powerful tool because it can be filed on any transaction at any threshold for any reason with absolutely no notice to the customer. The third report is the Designation of Exempt Person Form and the Structuring Report, both governed by Title 31 of the United States Code Section 5324. Structuring is the federal felony of intentionally breaking up a transaction to stay below the $10,000 currency transaction report threshold. The maximum penalty is 5 years in federal prison, plus a fine of up to $250,000, plus civil forfeiture of the structured funds. And here is the part that affects retirees the hardest. Structuring does not require any underlying crime. The money can be 100% clean. The money can be your retirement savings, your home sale proceeds, your insurance settlement, or your monthly Social Security checks. If the government can prove that you intentionally split a transaction to stay below the $10,000 threshold, you have committed a federal crime, even if every dollar involved is your own legal money. These 3 reports are the surveillance infrastructure of the American banking system. And once you understand how they work, you can finally understand the story of Carol Hinders. Carol Hinders is a 67-year-old grandmother who until 2013 owned and operated Mrs. Lady's Mexican Food, a small family restaurant in the town of Spirit Lake, Iowa, with a population of approximately 5,000 people. Carol had run the restaurant for 38 years. Her business was almost entirely cash. Her customers paid in cash. Her tip jar was filled with cash. She paid her suppliers in cash. And every 2 or 3 days, when the cash piled up in her register, Carol drove the cash to the bank and deposited it into her business account. Carol's deposits, like the deposits of almost every cash-heavy small business in America, were almost always under $10,000. They were under $10,000 because that is how much money fit comfortably in her bank deposit bag. They were under $10,000 because she did not want to leave the restaurant unguarded for longer than necessary. They were under $10,000 for every reasonable, legitimate business operations reason a small restaurant owner would have for making frequent, modest deposits. In May of 2013, two agents from the Internal Revenue Service Criminal Investigation Division walked into Mrs. Lady's Mexican Food and informed Carol that her entire bank account had been seized. The amount taken was $32,820, every dollar in the account. The reason given was that her deposit pattern, consistent under $10,000 deposits made multiple times per week, was a pattern consistent with structuring. There was no allegation that her money was the proceeds of a crime. There was no allegation that her business was illegal. There was no allegation of tax evasion. There was no criminal charge filed against her at any time before, during, or after the seizure. Carol was simply told that her money had been seized under the structuring statute, and if she wanted to recover it, she would have to file a civil claim, hire a lawyer at her own expense, prove to a federal court that she had not intended to evade the currency transaction report requirement, and convince a federal judge to release her own money back to her. The burden of proof in a civil asset forfeiture proceeding falls on the property owner, not on the government. The government is not required to prove she did anything wrong. She is required to prove she did not. Carol could not afford a lawyer. The seized money was her business operating capital. Without it, she could not pay her suppliers, her employees, or her rent. Mrs. Lady's Mexican Food was forced to close. Carol's case was eventually picked up on a pro bono basis by the Institute for Justice, a public interest law firm specializing in civil asset forfeiture defense. After more than a year of litigation and after national news coverage of her case, the Internal Revenue Service finally agreed in 2014 to return her $32,820. By that point, her business was permanently closed. Her 38 years of work were gone. The federal government never apologized, never admitted wrongdoing, and was never held legally accountable. Carol's case is not unusual. The Institute for Justice has documented hundreds of similar civil asset forfeiture cases against ordinary American small business owners and retirees. Every one of them seized under the structuring statute, almost none of them resulting in any criminal charge. And every single one of those cases started with a federal report filed by the customer's own bank under the account agreement clauses I just walked you through. Now, let me give you the historical explanation of how this happened, because the surveillance infrastructure I just described did not appear all at once. It was built piece by piece over the course of approximately 90 years in response to 4 specific historical events, and once you see the pattern, you cannot unsee it. In 1933, 3 weeks after taking office during the depths of the Great Depression, President Franklin Roosevelt signed Executive Order 612, which made it a federal crime for any American citizen to own more than $100 worth of physical gold coins or gold bullion. Citizens were ordered to surrender their gold to Federal Reserve banks in exchange for paper dollars at a fixed price set by the government. The penalty for non-compliance was up to 10 years in federal prison and a fine of $10,000. The order was justified on the grounds that the financial emergency required the government to control all monetary metal in private hands. In 1970, in response to organized crime money laundering during the rise of the modern drug trade, Congress passed the Bank Secrecy Act, which converted American banks into mandatory federal reporting agents and established the $10,000 currency transaction report threshold. In 2001, 6 weeks after the September 11th terrorist attacks, Congress passed Title III of the USA Patriot Act, which dramatically expanded the Bank Secrecy Act, mandated the creation of financial institutions' modern banking surveillance database, required every bank to develop and maintain anti-money laundering compliance programs, and authorized federal agencies to share banking data across the entire intelligence community. In 2024, financial institution issued updated guidance authorizing banks to delay senior customer transactions for up to 72 hours under elder financial exploitation suspicion, with full legal immunity for the bank. Regardless of whether the suspicion turns out to be correct, each of these 4 expansions was justified at the time on emergency or public safety grounds. Each of them remained permanently in effect long after the original emergency ended. And the cumulative result, 90 years later, is a federal banking surveillance system that monitors every meaningful transaction of every American citizen with reporting obligations on the bank and no notification rights for the customer. Now, here is why retirees specifically are the highest flag demographic in this entire system. There are 5 reasons, and they all stack on top of each other. Reason 1, retirees make larger, more visible cash transactions than any other age group. Medical bills, car purchases, family gifts, home repairs, second home down payments, and inheritance distributions all routinely exceed the $10,000 currency transaction report threshold. Reason 2, retirees have predictable, regular income streams from Social Security, pensions, and required minimum distributions. Any deviation from a retiree's normal transaction pattern is statistically much easier for the bank's compliance software to flag than the same deviation in a working-age customer with variable employment income. Reason 3, the 2024 Financial Institution Elder Fraud Guidance gives banks both the authority and the immunity to flag senior accounts on transactions that would not be flagged on younger accounts. Reason 4, retirees are statistically more likely to want physical cash on hand for emergencies, which directly conflicts with the structuring statute. Reason 5, retirees are less likely to litigate when their account is flagged or their funds are held. The federal banking surveillance system depends on most flagged customers simply waiting out the hold period, accepting the inconvenience, and not pushing back. Retirees statistically do exactly that. If you are a retiree with significant savings in any major American bank, the surveillance system is calibrated to flag you more aggressively than any other customer demographic. And the only effective response is to put a series of protection moves in place before any transaction triggers any report. Here are the 5 moves every retiree needs to take in order this week. Protection move number 1. Build a physical cash reserve kept outside the banking system of 2 to 4 months of essential living expenses. The reserve should be stored in a fireproof, waterproof safe in your home in a location your spouse and trusted contact know about. The reserve should be rebuilt slowly with cash withdrawals of less than $1,000 at a time, taken at the same teller on the same day of the week over a period of months. This is not structuring under federal law because structuring requires intent to evade a currency transaction report. Withdrawals of $1,000 do not approach the $10,000 threshold and do not qualify. The point of the reserve is not to evade reports. The point is to have access to your own money during a banking hold freeze that you cannot predict in advance. Protection move number 2. Spread your savings across multiple banks. The federal deposit insurance limit is $250,000 per depositor per bank per ownership category. Holding more than $250,000 in a single bank exposes you to 2 risks at once: the loss of FDIC insurance on the excess and the concentration of your entire savings under one set of account agreement clauses that allow the bank to freeze, hold, or close your relationship at any time. Splitting your savings across at least 3 different banks reduces both risks dramatically. Protection move number 3. Move long-term savings from bank accounts to United States Treasury securities purchased directly through treasurydirect.gov. Treasury securities pay competitive interest, are not held inside the commercial banking system, are not subject to account agreement clauses, and cannot be frozen by a commercial bank's compliance officer. They are in addition the safest dollar-denominated investment available, backed by the full faith and credit of the United States government. For retirees, the combination of safety, yield, and removal from bank account exposure is the single most important asset allocation move available. Protection move number 4. Replace your primary bank with a credit union or at least open a parallel account at a credit union. Credit unions are member-owned financial cooperatives, not-for-profit corporations. Their compliance teams are smaller. Their incentive to file aggressive suspicious activity reports is lower, and the relationship quality you receive at the teller window is significantly different. Credit unions are still required to comply with the Bank Secrecy Act and Patriot Act, but the volume of discretionary suspicious activity reports filed by credit unions is on a per-customer basis dramatically lower than the volume filed by major commercial banks. Protection move number 5. Document every cash transaction over $5,000 in writing before the transaction occurs. Keep a spreadsheet or notebook with the date, the amount, the source of the funds, the recipient, and the purpose of the transaction. The documentation does not have to be complicated. A single page in a notebook is enough. The reason this matters so much is that almost every civil asset forfeiture case, every structuring inquiry, and every suspicious activity report investigation turns on the question of whether the customer can produce contemporaneous documentation showing why the transaction pattern looked the way it looked. If you can show the reviewing agent a clean record of why every transaction occurred, you have a complete defense to almost every possible federal inquiry. If you cannot, you are relying on the agent to take your word for it, which is a much weaker position. Now, before I close, let me tell you about a resource I have built for exactly the kind of retiree who just watched this video. My team and I have assembled the 2026 Retiree Protection Checklist. It is a 42-page comprehensive guide that covers every clause in the standard account agreement that you need to know about the complete protocol for setting up the 5 protection moves. I just walked through the specific banks that have the strongest senior protection records and the specific ones to consider moving away from the 7 most commonly missed deductions retirees lose every year. The 4 estate planning mistakes that cost the average American family over $100,000 in avoidable taxes, and the 9 Social Security and Medicare timing decisions retirees most commonly get wrong. It is 42 pages. It is completely free. To get the checklist sent directly to you, go to marcusgraves.kit.com/checklist. Enter your email and the full checklist will be in your inbox within a few minutes. And while we are talking about taking control of your financial life for any retiree who handles their own tax filing, I want you to look at TaxSlayer. TaxSlayer is the software I personally recommend to clients who are comfortable filing on their own. It is significantly less expensive than the major competitors you have heard of. It handles every situation a retiree is going to face, including Social Security income, pension distributions, required minimum distributions, capital gains, and the 1099-K reporting requirements that come with the new lower payment thresholds. And it is backed by a team of tax professionals you can actually reach on the phone if you get stuck. The link is in the description below this video, and using that link supports this channel at no additional cost to you. Let me close with the most important point I can make in this entire video. The account agreement you sign when you open your bank account is a legal contract. Every clause inside it is enforceable. Every right the bank reserved is a right you granted. The Bank Secrecy Act of 1970, the Patriot Act of 2001, and the Financial Institution Guidance of 2024 are not laws that might apply to you in the future. There are laws that apply to every transaction you have already made, every report your bank has already filed, and every flag already attached to your account. You cannot unsign the account agreement. You cannot opt out of the federal banking surveillance system. You cannot prevent your bank from filing reports on you. But you can put protections in place that mean when the system flags you, your own money stays under your own control. A physical cash reserve outside the system, savings spread across multiple banks, long-term funds in Treasury securities, not commercial bank accounts, a primary banking relationship at a credit union, not a mega bank, and contemporaneous documentation of every meaningful transaction. Carol Hinders did not have any of those protections. The federal banking surveillance system flagged her. Her money was seized, her business closed, and the only reason she eventually recovered her $32,820 was that a public interest law firm took her case for free and the press covered it. The vast majority of retirees who get flagged never get their money back. The federal government keeps the money. The bank keeps the relationship. The retiree absorbs the loss. You do not have to be the next Carol. You have the information now. You have the 5 protection moves. You have the checklist. The only thing left is to act on it before the next time the system flags one of your transactions. If this video was helpful, please hit the like button because that is the single most important signal that tells the YouTube algorithm to show this video to more retirees who need to see it. Subscribe if you have not already, because next week I am releasing a follow-up video on the 3 specific banks with the strongest senior protection records, and the 2 banks every retiree should consider moving their savings away from before the end of this year. And if you know a friend, a sibling, a parent, or a neighbor over the age of 60 who has significant savings in a major American bank, send this video to them directly. The account agreement they signed is the same one you signed. The clauses inside it are the same, and the federal banking surveillance system is calibrated to flag every single one of them just as aggressively as it is calibrated to flag you. I will see you in the next